In this video,
We're going to break down exactly why banks fail so that you know what's really happening behind the scenes with your hard-earned cash. And you can finally stop stressing about whether your money is actually safe.
let's get into it.
The bank run, when everyone panics. All right, so to understand how a bank collapses, we first need to talk about a little thing called fractional reserve banking. See, when you deposit $1,000, the bank doesn't just lock it in a vault with your name on it. They keep a tiny fraction of it on hand, and they lend out the rest to other people, buying houses or starting businesses. It's a great system until people get scared. If rumors start flying that a bank is struggling, everybody rushes to pull their money out at the exact same time. This is called a bank run. Since the bank only holds a fraction of the cash, they run out of liquid money fast. They face a liquidity crisis, meaning they literally don't have enough cash on hand to pay everyone. But a lack of cash is just one piece of the puzzle, and wait till you see the other massive reason banks go belly up, which we'll get into right now. Bad bets, toxic assets, and poor investments. So remember how I said banks take your money and invest it? Well, sometimes they make really terrible bets. They might hand out too many risky loans that people can't pay back, or they might buy long-term bonds. Now, bonds are usually safe, but if interest rates suddenly shoot way up, the value of those old bonds drops like a rock. If the value of the bank's investments falls so much that their liabilities, meaning the money they owe depositors like you, become greater than their assets, the bank becomes insolvent. Basically, they're dead broke. You definitely don't want to find out that the institution holding your life savings has turned into a giant financial dumpster fire. But the nightmare doesn't always stop with just one bank, which leads us to our next point.
By the way, if you're getting value out of this video, hit like, subscribe, and tap the notification bell to get more valuable content like this.
The domino effect, when one takes down the rest. Okay, now we've got to talk about contagion. The banking system is heavily interconnected. Banks constantly borrow and lend money to each other. So if one massive bank fails, the panic spreads. People at other perfectly healthy banks get spooked and start demanding their cash too. It's a psychological domino effect. This is why you hear about government regulators stepping in to stop the bleeding. They want to prevent a total systemic collapse. Now, you've probably heard of the FDIC, which stands for the Federal Deposit Insurance Corporation. They're the ones who swoop in when a bank fails in the US to make sure everyday depositors get their money back, usually up to $250,000 per account. So, what does this all mean for you? It means that as long as you're banking with an FDIC-insured institution and keeping your balances under the legal limit, you don't need to lose any sleep over bank runs or toxic assets. Your money is protected, even if the bank's executives make terrible choices. Just remember, this video is for educational purposes only and isn't formal financial advice.
If this video helped, leave a comment below. If you want to keep learning, check out this video next. Thanks for watching, and I'll see you in the next video.